Welcome back to Business Talk here on businesstech.co.za. And today we're talking about a concept that I think every investor's heard of, but very few actually get right in practice. Yes, we're talking about diversification. They call it one of the only free lunches in investing. And this intuition that diversification reduces risk goes back centuries. I was having a look ahead of this interview. The expression, don't put all your eggs in one basket, that can be traced back to a quote from Don Quixote in 1605. But it may have been more commonplace before then. That's the earliest record we've got of it, though. But the scientific measurement of diversification has a much shorter history. Just over 70 years ago, we had Harry Markowitz in the 1950s published Portfolio Selection, and that laid the foundations of modern portfolio theory, and it won him a Nobel Prize. And it showed that a portfolio's risk isn't defined by the average riskiness of its individual assets, by the extent to which the returns on those assets are correlated or moved together. So that was fascinating. And to help us figure out how to strike that Goldilocks balance, not too hot, not too cold, we're joined once again by Wendy Myers, Head of PSG Securities. Wendy, great to have you back on the show. Let's just start at the top. Diversification 101. It gets thrown around almost as this magical principle in investing. Just diversify and you'll be fine. But how important really is diversification for individual investors trying to build wealth in 2025?
Well, Michael, I think it's one of the most critical decisions to make as an investor after deciding what your risk appetite is. I think any investor, if they don't diversify their portfolio fairly and well, they have such ramifications on achieving their financial goals. So I think any investor needs to stand back and say to themselves, given that I want to invest, how do I want to do it with the right outcome? And diversification is your ticket to the game. It helps reduce risk without actually sacrificing potential returns. And I think it's important for investors to understand there's different types of diversification. And I think that's what we need to maybe unpack today, Michael.
Yeah, the how. And I think that how is important. I think it's quite easy to understand the importance of diversification conceptually. But I think implementing it in practice is where many investors might trip themselves up, because there's so many ways to diversify. You can go across sectors, across geographies, across currencies. How does one actually determine how much to diversify into local versus offshore or across industries? What are the guiding principles here when you approach this?
Yeah, so I think before I would start, so my focus as an investor has always been to say, let me look at my risk tolerance, look at my investment goals, my time horizon, and what assets I want to be in. And I think it's important to note that any risk-averse investor tends to favor lower risk assets, obviously. So things like bonds and cash, whereas those that are risk tolerant will always go and should always go for high risk, high potential returns, because that's going to deliver on your financial goals. I think it's important to understand that age and time, we always talk about it, but they're critical in deciding, do I want to be exposed to the riskier assets? So certainly those younger investors, this is the time to take risk, be invested in shares more so than in cash and bonds. And so once that's decided and you're very clear on your tolerance levels, then you get into the science of how do I diversify my investable assets? And for me, I would always start with saying, well, if I need to diversify, what am I comfortable with when I consider local investments versus offshore? Certainly at PSG, we advocate 60% local, 40% offshore, because you need to be comfortable with that split. Dollar gains are wonderful, but what if you get dollar losses? And that impacts the psychology of investing. Another way to achieve diversification is in looking at the different types of sectors you're invested in. Think technology, think the commodity sector, the gold's done incredibly well of late. Think financial, some great stocks to be invested in there. But it's important to know an investor doesn't have to be invested in every single sector to achieve diversification. You need to pick the sectors that you relate to, that work for you, pick high quality companies in those sectors. And then I think the most critical thing is maybe have 20 to 25 shares in your portfolio, and that will achieve diversification. You don't need to to do more than that.
20 to 25. I mean, that's interesting because I was going to ask you on the other side, when I have this conversation with friends, they say, "Oh, but if you diversify, then how are you going to outperform because you just kind of dilute your returns?" Is there such a thing as being too diversified?
Yeah, there is actually. I mean, it's fascinating to me. So Warren Buffett, he's such an inspirational man. He talks about why diversification, and I think it's hilarious. He says basically, if investors don't know what they're doing, they actually invest too widely. So basically, his concept is you need to diversify, but not so much that you trend sideways. So you can achieve and obtain the right diversification with about 20 to 25 stocks. Anything more than that, you actually don't achieve anything. You limit your upside. And I think, diversification to me, it's like ice cream or good red wine. It's good, but in moderation. If you do it too much, then your portfolio tracks sideways and it's almost confused. It doesn't know where it's going, and there's no upside. And the whole point of investing is to have that upside, and to achieve your financial goals.
Well, given that, what do we do then when we come to selecting the building blocks? Do we go directly ETFs, unit trusts? Because there's always this question: do I pick individual shares? Do I just buy ETFs and let someone else sweat the details? I'm sure there are pros and cons for individual investors on each side. So maybe you can just take me through how you approach it at PSG.
So I think there's a place for shares, ETFs, and unit trusts in a portfolio, and it's really up to the investor. So those that are not wanting the volatility, absolutely, unit trust is the way to go. And ETFs in your portfolio, certainly, some of those index funds can absolutely contribute towards diversification. But I think it's important to know what you're getting. What are the pros and cons when you compare shares to ETFs? Now, I'm obviously in favor of individual shares, but I understand the importance of having ETFs as part of that diversification. To me, what's the benefit of having exposure to individual stocks is that that can be the game changer to outperform the ETF, because the ETF will track similar to a unit trust. It's going to have very low volatility share movements. You're able, as the investor, to take direct control of deciding what investments or what shares to be invested in, when to buy and sell. And I quite like having that control. I must be honest with you. Plus, I also want to be invested in those shares that are meaningful to me. And
Yeah.
then very conscious of fees. I talk about that a lot. When you're buying and selling shares, you're incurring brokerage. But with an ETF, you need to remember that you're paying a management fee to the issuer of the ETF. And then just on the negative side of share selection, we all know that a poorly chosen stock can lead to substantial losses. I mean, some losses can be as much as 80%. I've seen it. It can be very real. And you need to make an effort to do the research when you want to be invested in individual stocks. And some investors don't want to do that. But if you're passionate about investing and you have an interest in shares, this is the exciting way of investing, because you can really make the effort and deliver solid gains for your benefit because you show an interest and you make the effort to research. Then always remember the higher volatility. I believe that is a benefit to the investor because you can pick some good entry levels. But ultimately, I think if volatility is a concern for you, then certainly consider a higher proportion of ETFs in your portfolio. But I would prefer it to be less.
And there's also such good research out in the market. I was chatting to Michael Dodd of Morningstar, and they've brought their global active passive barometer to South Africa. So they have a look at performance of active managers versus the ETFs or the passive strategies over 1 year, 5 year, and 10 year period, locally and offshore. And the interesting thing is that locally, active does tend to outperform over the short term. Over the longer term, it comes down to about 35%, but it's still much more than offshore, where offshore active managers really do struggle to beat the benchmark. I think that the dynamics of those markets and, kind of efficient market theory and all of that comes into play. So if you look at that, you can say, well, maybe I'll use an ETF to go offshore to build that building block, but locally, I'm going to pick some local stocks. I think I can maybe outperform there and one that speaks to me a little bit more. So, I mean, it again comes down to your risk tolerance. But there's a lot of information that investors can go and use to inform those decisions. Just zooming out a bit, I mean, such an interesting time. We chatting in the midst of this Iran-Israel conflict. We've seen oil kind of shoot through the 70s, but is now holding steady. The Fed recently signaled that it's worried about growth, so we might start to see some cuts. Where should individual investors be looking right now? Are there particular markets or sectors or themes that are looking especially attractive or resilient amidst all of this geopolitical volatility?
Yeah, thanks, Michael. So definitely, I think there's actually surprisingly a renewed focus on emerging markets, which is lovely to hear, and that's because of their low valuations and potential for growth, and that's because we're entering an interest rate cutting cycle. So South African equities are very popular at the moment and have actually delivered very good returns so far this year. So it's nice from an SA Inc. perspective that we're seeing South Africans enjoying those improved returns. And I think there's also the expectation of improved economic growth this year and next year. So again, I would say even focusing on South African equities this year and next year is a good strategy to have. If I had to select a sector, I'm still very much in favor of the technology sector offshore. E-commerce and AI, I mean, I know NVIDIA has been on a tear, it's pulled back quite a bit, but still, I think for the long term, we have to consider what AI is going to do and how it's going to change the way we work and the types of roles and jobs that are available. And I think for any investor to have exposure to those stocks that are investing in AI, think Alphabet, think Amazon, Microsoft, they've invested literally billions of dollars into accelerating their AI use. And I think it's important for us to have a piece of that. So I would really consider looking at those stocks and say to yourself, be invested in them for the long term.
Well, those are great insights, Wendy. Thanks as always. Making it clear that diversification isn't just about owning a bit of everything, it's about owning the right mix for the right reasons at the right time as well. And to our listeners, if your current investment strategy is just throw spaghetti at the Jesse and hope for the best, it might be time to get some proper advice. That's it for Business Talk today. Until next time, stay diversified, but please no more owning 42 ETFs and calling it a strategy. From me, Michael Avery, have a great day.